Yes, thanks, John, and thanks for the possibility to attend this fantastic conference again. So let me start with the positives, which have already been mentioned, actually. Well, many of my points have already been mentioned during the morning, but I will still go through. So Greece has obviously come a very long way since the sovereign debt crisis. And there was significant progress in addressing the economic and fiscal imbalances, thanks to all the structural and institutional changes that have been adopted, which has also been reflected in the resilience of the economy in the COVID crisis and the following crisis. And so last year, growth was at 2%, which is, as was mentioned already, well above the euro area average growth, and is forecast to remain around this value in this year and next. Also, the resilience of the Greek banking sector has significantly improved. The fundamentals of the banks have improved. The core profitability has been among the highest in the euro area last year. Asset quality has also improved, mainly thanks to the Hercules asset protection scheme. Non-performing loans went down from over 40% in 2019 to around 5% by end 23. So this progressive unwinding of imbalances has also been reflected in the falling sovereign spread, which since May 23 are below the Italian spread. And investors' confidence has also returned, which is also reflected in inflow in foreign direct investment to the country. So achieving investment grade status, not with Moody's, but with 3 other rating agencies, is of course a key milestone for Greece, and it signifies confidence in the country's economic stability and governance. And it's also a substantial boost for the Greek economy. Lower borrowing costs and increasing confidence allow for more investment, more job creation, and higher growth. So the critical question at this juncture is how sustainable these achievements are and what remains to be done. Now, in the current volatile environment, I would not dare to make very big projections of growth because it's very difficult. But as I just mentioned, what we have seen is that the Greek economy has rebounded well from the pandemic slump. The growth potential has increased a lot compared to the past decade. But that means that it's currently at 1%, whereas it used to be in the negative realm. And that also means, though, that at 1%, there is not a lot of convergence to EU average. And even at the current growth rate of 2%, it will take a lot of time to catch up. So I think that's really the thing to work on. While cost competitiveness has improved a lot, the non-cost competitiveness, that is productivity, again, it was mentioned in several sections in the morning. There is ample scope to improve this. Now, this can, of course, and again, I will not be very revolutionary, regulatory environment, public administration, justice, tax administration, all the reforms in these areas need to continue. The same holds actually for the financial sector, which, as I said, has become much more resilient. But the level and the quality of the capital can still be increased, as can the long-term profitability of the banks, which actually, as Martin just said in the previous panel, last year's high profitability was mostly due to the margins. So it would be good to also increase the loan portfolio and to go into more lending to the economy. And then I would also stress, as Declan did, the employment and activity rate to tap the full capacity of the Greek population, female employment, but also education and the quality of healthcare, which are important. Now, all this, of course, was discussed in a volatile global environment. And as Alternate Minister Papathanasis also insisted, there is a continued need to pursue prudent fiscal policies, and it's welcome that this is high on the government's agenda. So, in conclusion, while Greece has made substantial progress, the journey is far from over, and of course the EU keeps supporting the Greek economy with RRF and other available funds.